Here they have this morning with the city truck and a trailer to come and pick everything up. We're gonna try and
Actually, they are live.
Yeah, so right now it's actually good. It's too pretty. That's what not be.
Yes.
You try.
Actually have money time. Did you get that? You got your hearing aids in? Yeah. Okay.
Y'all ready?
Yes.
All righty, it's about 2:44, 2:41. September 6th, 2022. We have a workshop today posted, Commissioners Court, Liberty County, Texas. And this is to discuss insurance quotes from the Texas Association of Counties. Now, Ashley, you're here with TAC, correct? Okay. He'll be discussing the wellness side.
Yes.
Wellness clinics, okay. Then Orlando, can you hear me?
I sure can. Can you hear me?
You bet. You bet you. And you're going to be leading us in discussion on the TAC proposal, correct?
Yes, yes, sir. Yes, sir.
Okay. Well, that being said, Commissioner Karbowski's here, Commissioner Wilson's online, Commissioner Arthur's here. Commissioner Whitmire has COVID, so he won't be with us today. Of course, Ms. Harris and Mr. Poston are with us as well, and Sheriff Rader. So with that being said, Orlando, take it away. Let's hear all the good points, bad points, in between points.
All right. Well, thank you so much. Unfortunately, I am dealing with COVID as well, which is why I wasn't able to be there in person. I was planning on being there. So I'm going to tough it out and see if I can get through this with you guys. Do you want me to share the proposal with you guys on the screen?
I have a hard copy.
Okay.
I think everybody's got a copy. We got some copies over here. If anybody.
Leon, do you have a hard copy?
Not in hand.
Okay. Would you prefer that Orlando share it on screen?
That would,
Harold's got some right there.
I would appreciate it.
Okay. Orlando, if you can share it so Commissioner Wilson can see it as well.
Okay. So I'm trying to share, but it's saying that the host disabled participant screen sharing. So as they get that set up, I'll go ahead and just get started, just kind of talking. We won't go over any numbers until we can go. But for now, I'll just kind of just get started on a little bit about TAC as a whole. So we are a not-for-profit pool that was designed by the legislature for the counties of Texas. So with that being said, we don't have any profit margins in our, in what we do. So that's kind of part of the reason how we're able to do what we're able to do in terms of keeping rates low and whatnot. So over the last 7 years, we have managed to keep our renewals at about 4.5% for the pool needed amount. So the amount that we've had to increase by has been, about 4.5% over 7 years, which is well below the market. So that's kind of who we are in a nutshell in terms of, we have a board of directors that is strictly made up of elected officials, but county officials. So we are owned and governed by the counties of Texas. So, obviously the decision makers of the pool are, elected officials that are, have the county's best interest in mind. So everything that we do is all centered around what's best for the counties. So with that being said, what we pride ourselves on doing is being able to provide stability to our groups, being able to come in and basically, we understand the budgets. We understand the budgets of our counties and how difficult it is sometimes, and how large increases to one of your largest budget line items is pretty hard to come by. So we try to minimize those as much as we can, and try to keep you guys stabilized as much as we can with the different things that we do. And so you'll hear from Ashley Kierton, who's there. Everyone calls her my better half on the road. But she will be there to talk to you guys about the Healthy County, which is our wellness program, which honestly is a big reason why we're able to do what we're able to do in terms of keeping our rates stable. And, the more that we can get people involved in that, the better it is for groups. So she'll kind of touch on that in a little bit. But I just wanted to kind of set the table in terms of who we are and what we do. So before I keep going with the actual, numbers and stuff, I just wanted to see if you guys had any questions about TAC and about how we operate on, with our renewals and stuff.
I believe that's a pretty good introduction there. It
Let's see if this works.
tells us what you do and what you are and who you represent and how it's basically governed. So let's keep moving forward.
Awesome. Okay. So with TAC, you will have a team. If you move to TAC, you will have a team of 3 people. That's your customer facing team. So that's going to be myself as your employee benefits consultant. So I'll deal with the renewal, questions about, larger items, strategy, just kind of helping you guys with that. And then, and I think, oh, there we go. All right, let's see.
He's got it.
Okay.
All right, can you guys see? Are you guys looking at the proposal?
No, we don't see it yet.
Okay, let's see.
Stop our share. Hold on a second. Okay, Orlando, you should be the host now. Can you try to share?
Yeah, let's see. All right, can you guys see it?
No.
All right, can you see the proposal?
Yes, sir.
No, we see
The documents, yes.
Okay, here we go. All right, so you have a customer facing team through TAC. So as I mentioned myself, I'm the employee benefits consultant. I'm here to talk to you guys about strategy, work with you guys at renewal, open enrollment presentations, that kind of stuff. Then you have Ashley Kierton, who's there. Her job is probably the most important of us all to try to help you guys. I think the way that I like to do it is if you are, if you're familiar with the property and casualty coverage, you'll have a risk control consultant. So someone who kind of helps talk about safety and, how to avoid injuries and stuff like that. Well, that is the equivalent of what Ashley does for you. So she, on the health insurance side, so she tries to avoid as many claims as possible by, talking about wellness, doing presentations to employees, talking to them all about the different programs that are available to them. And the main goal of her is to basically just help our counties get healthier and prevent some of those claims. And then you have an in-house person. So Haley Gajewski, she's our employee benefits specialist. So she is your in-house person who's in the office, all the day-to-day questions, eligibility, claims, billing, that's all the stuff that she handles. So we work together along with our vendor partners. So Blue Cross Blue Shield is who we use for our medical. So you're already with Blue Cross Blue Shield. And so the network, all that will stay the same. The big difference is that our prescription coverage is not through the same as what you're currently using. So we're currently using Navitus for our prescription benefits manager. So that is the one thing that will be a little bit different in terms of what you currently have versus what we're offering to the members, at least to your employees. And we can talk a little bit more about that in a little bit, but just wanted to point out the team. And we also have, we work with Navitus, Voya for life, Blue Cross for medical and dental. So this is your TAC team. And then we also have our teams that we use to help us, administer your plan. And then looking at what you currently have versus what we're offering, the conversations that we've had, we're basically just looking at currently you're self-funded. So you're self-funded, you have your cost that you are, that you're basically on the hook for the claims. So, you could have good years, you could have bad years, but at the end of the day, you're on the hook for those claims. And so what we did was we came in with a fully insured quote. So basically what we do is we're able to take off, get rid of that risk that's involved with.
Can we get that off the screen?
What was that?
Thank you.
Oh,
There was
Um,
no across the screen. I couldn't see it.
okay. Yeah, so what we did was we came in with fully insured quote, basically looking at what your current costs are when you're looking at your looking at how much you guys are putting aside funding for claims, your stop loss coverage, admin coverage, funding your HRA currently. And so what we did was we took your total cost and we try to be around the same as what you're currently at and provide that as a fully insured quote, basically being able to say, your budget's going to stay around the same. However, if you have a bad year, you're not responsible for those claims. Your budget will be set and you will pay what the cost of what we're charging you, which is your premium. And that's all. You're not going to have those. If there's a large claim, you're not going to have to pay that out of pocket. You're paying your premium, and then all the rest of it is being paid by TAC. So just basically what we wanted to do is we wanted to provide stability. And going back to at the beginning of what I was saying was that just that stability of being able to set it and forget it, right? Setting your budget and then not having to worry about it and not having to come back a couple months later and saying, oh, we need to go back to the general fund to pull out more money because now we have more claims than what we expected. And so now we have to go in and we have to try to readjust things. So being able to provide that stability in terms of the rates and being able to say, hey, this is what we're going to pay for this year, and that's the budget, and we don't have to change it. And we don't have to go back and dip into any of these funds. And on top of that, what we do is we not only provide these kind of quotes. What we also do is we also provide something called surplus distribution. So surplus distribution is a way for us to give back to our members. So by giving back to our members, what we're doing is at the end of the year, depending on what the surplus is, if we made a profit, what we do is we basically take that to the court, which, as I mentioned, is all elected officials, and the elected officials basically decide how we're handling that money. Most of the time, what the board will look is that they will give that money back to our members. That is pretty much what they've always done. So in years that we've had a pretty big surplus, what they've done is that they've given that money back to our counties, but they've split that up into a couple of different years. So let's say 2 to 3 years. So then if we have let's say a $10 million, surplus, they will take that 10 million and they will split that up into 2 or 3 years. And then we will determine how much money each group gets back based off of how much they've contributed. It's a little bit of a formula, but we look at how long you've been with the pool. So even if we're losing money on you, if you've been with the pool for a very long time, you're still getting a check back in surplus distribution. Because we want to reward our members for being loyal and for sticking it out, because this is moving to TAC is a long-term play. It's not we're not going to come in and try to come in 20% below your rates. We're not going to try to ever buy the business. Our goal is stability. So stability means accuracy and being able to accurately predict how much we have to collect for each group. And so when we're accurate, that means that we don't have to come in way below. And then, next year, let's say we come in 20% below, but then we lost a bunch of money. And then next year, we're going to raise your rates by, 25%. You'll never get that from TAC because we will come in at the amount that we need. And then the following year, you'll receive a renewal that is accurate to what your numbers are saying. So with that being said, we have provided a single plan, self-insured plan, a fully insured plan. That is, it's a little bit different than the current plan that you offer, but it is richer in some areas. So right now you're offering an HRA plan and funding that HRA. So what we're looking at doing is offering a PPO plan where you have your copays. It's a $1,500 deductible versus I believe right now you have a $3,000 deductible and you guys are funding about $1,000 of that. So this would be a lower amount that the members actually have, a felt deductible for them. And they're not paying that deductible out of pocket from the start. What they're doing is they're paying their copays for, any regular visits, and it is a non-grandfathered plan. So any preventative services are going to be covered at no cost. So all your routine annual exams, colonoscopies, mammograms, all that stuff is going to be covered at no cost to them. So no copays, they're not going to pay anything for that. And then your prescription plan, as I mentioned earlier, with Navitus is at a 10, there's zero deductible on it, and it's a $10 tier 1 and a $75 tier 3 copays. We also offer 90-day refills instead of 30 days, and those are offered at 2 co-payments versus 3. And one thing that's a little bit different about our pharmacy plan is we do not we don't work with the terminology that most people are used to, which is the generic brand name and specialty. We kind of got away with that, got away from that, simply because we realize it's a game. Those drugs get moved from generic to brand name, kind of depending on what is the best option for the drug manufacturers and the pharmacy benefits managers. So what we did was we went to an approach where it's a 3-tier drug system where the lowest cost option, regardless of whether it is considered a generic or a brand name, the lowest cost option to us is going to be our tier 1. Obviously, with drugs being equivalent, we're not looking at just saving money. We're looking at making sure that we're getting the highest quality drugs at the lowest available cost. So we used to be with CVS Caremark about 4 years ago. So about 4 years ago, we made the switch to Navitus, to this new system where with Caremark, it always felt like we were chasing rebates and paying high cost for high cost drugs and then getting a fraction of it back in rebates, but ultimately just paying a lot more. So when we moved to Navitus, what we were able to do was we were able to actually reduce our cost on pharmacy by 30%. And we've been able to keep those savings over the past 4 years since we moved there, just simply stopping chasing those rebates and just kind of going to the lowest cost option. So that's a little bit about the quote we have. You have the numbers there. So the different employee tiers. So these numbers were based off of what your current spending is, and then breaking it down based off your current membership, and looking at that and kind of divvying that up the way it needs to be divvied up. So I'm going to go ahead and stop now and wait to see if there's any questions on this portion of it so far.
Orlando,
Yes.
this is Kim Harris. Can you hear me?
Yes.
Hi, how are you today, Orlando?
Outside of dealing with COVID, I'm doing pretty well.
Okay, well, I hope you feel better. Listen, Chuck Robinson is in the waiting room, and I understand that you're hosting the meeting currently. So if you wouldn't mind, would you let him in?
Okay, yeah, give me a second. Let me see if I can.
Okay, and once you do that, I did have a question on the Navitus network on the medication. So is there any way that you can provide us with sort of a disruption report on what effect this would have on our employees with the switch to the Navitus network?
Yeah, so we can definitely provide our formulary. So looking at our formulary, seeing what drugs are currently covered on our formulary, and then looking at what your current formulary is with Blue Cross Blue Shield, looking at what the differences are there. So I will say that moving to TAC it will take a little bit of time, but basically what we'll do is I'm sure that right now there's going to be a little bit of a disruption in terms of drugs that are currently being paid for that are not on our formulary. However, we do work with our groups and kind of doing where we'll try to get them to, our members, we'll let them know if they're currently on a drug that is not covered, to either say, hey, we're going to give this to you for another, let's see, we'll cover it for one more refill for 90 days. And then in that time, have that conversation with your doctor, let them know that this drug is not covered, and then kind of working with them on that. But we're always available to, if anyone has any questions, if anyone's having any issues, they can always call Navitus and just kind of, one of the biggest things that I like to stress to our members is that anytime you move to TAC, it is imperative to set up open enrollment presentations. And myself and Ashley will go and basically do these presentations where we talk about the benefits and explain them thoroughly, answer those questions that members have about, obviously, anytime that things are changing, members are going to have questions. So we can go and we can do those presentations and not have to put that burden on you guys to know the ins and outs of it. And that way we're there to answer those questions and point them in the right direction in terms of who do you go to for these kinds of questions? If you have a question, if there's a prescription that you're trying to get filled that they're saying it's not covered now, what can you do? And so those are the things that, we really want to be able to help with, because, not every drug is going to be covered the same. So being able to get in front of the members beforehand and telling them that is definitely going to be something where where we want to do that. We want to be able to help them in this transition.
Okay, but it is something that we should consider when we take a look at the potential move to TAC would be the disruption in the pharmacy coverage.
Absolutely.
Agree. Yes.
Absolutely. Yeah. Yeah. No, it's definitely something to consider. But now I will tell you that the flip side of, the flip side of making that change, and obviously, yes, it is something that you guys have to figure out on your own of whether it's something that's worth it or not. But I will tell you, the biggest thing that we try to do is we try to save costs by doing this, by obviously being able to offer these members the best drugs available at the lowest cost, and that in turn saves the county money, saves us money by doing that. So that is part of the conversation also, right? There's always going to be growing pains when you're making a change. So is it worth it to, basically the question you have to ask yourself is it worth it to see those positive changes, on the other side of it? That's how I would present it, because it is definitely something that we've proven has worked. And yeah, of course, when we made the big switch, so we moved over all 230 groups at one time, and we had tons of upset people. We had tons of just growing pains and stuff like that, but that didn't last very long. People were able to get on medications that worked for them at a much lower cost to them, at a much lower cost to us. And after maybe 4 or 5 months, we kind of stopped hearing those, and I'm talking about everyone moving, not just one group. So we dealt with the brunt of it when we moved everyone. And, it takes a little bit of time, but, after that, it all kind of levels out and you don't really hear as much about it. We don't hear much at all now in terms of people being upset about drugs not being covered and stuff like that. So it's definitely something that has its growing pains, but definitely something that definitely levels out.
Orlando.
Yes, sir.
Leon Wilson. Give me a little more definition of disruption, and also what the duration of this disruption would be.
So there's no real telling of how long the disruption is going to go on. But what I will say is that we do work with our members on making sure that they know. So what we'll do is beforehand, when I come in and do open enrollment presentations, I tell them, hey, if you're on a current medication right now that you've been taking, before let's say before January 1st, when the plan becomes effective, you can call Navitus and you can ask them. You can say, hey, I'm currently taking this drug. Is this going to be covered? And then they can let you know whether it is covered, it's not covered, and then what tier it falls in. And so I think it's all about education. The more we can educate members about the change, the less disruption we will see. If we just kind of go at it with no education on it, then of course there's just going to be a ton of people that are just going to be upset about it. But the more we can actually, and that's where we come in, and that's where we help, is just kind of having those conversations and giving your members the help that they need and the resources that they need to be able to have those conversations. And then whenever the change does happen, working with those members on making sure that they're not going out with medication and putting in exceptions when there needs to be one, just to have that conversation with their doctor and see if there's anything that we can do. So, we try to minimize that as much as possible. And then a part of that is also going to be, Navitus will also send out letters to members that are on drugs that are not covered, just letting them know, hey, you're currently on a plan that is on a drug that is not covered by the new insurance, let's say, and kind of helping them figure out, okay, what needs to happen at this point. So it's a collaboration between TAC and Liberty County on making sure that the education is there and that the notifications are there, and that the help is there for members when they need it to kind of minimize those growing pains as much as possible and make it to where they're getting the help that they need and they're not feeling alone in this change. We know better than anyone. When you try to change someone's drugs, they don't like it, especially if they've been taking the same medication for a long time. It's a very hard change. So that's why we put in a lot of work into trying to minimize the disruption as much as we can.
Orlando,
Yes, sir.
Commissioner Karbowski here. On our current plan, explain to me the difference in our current plan and the one that you're offering. Right now for medications or prescriptions, I'm allotted $1,500 per year. During the middle of the year, I'm out and it's like I don't have insurance. How would your rate or how would your plan compare to this?
When you say in the middle of the year, it's like you don't have insurance. What is that? What do you mean by that?
Because I've used the $1,500.
So you
And then
pay,
you're-
Yeah, you pay it out of pocket. It's
It's
like I have no
there's a
insurance.
Maximum
Yeah.
for the out of pocket or what is covered under their current prescription plan.
Yeah. So with our plan, basically you're just paying copays. As long as you're on the plan, you're just paying your copays. So you're either going in and you're paying $10, you're paying $50, or you're paying $75. And if you're on a maintenance medication, you can get a 90-day refill, and it'll be 2 times your copayment instead of 3 times. So there's not really that. Not ever going to really be that.
It doesn't make a difference of how much you're spending. You're still deductible. Deductible is only 10, 50, or 75, whether it's 30, 60, or 90 days.
So they'll do either 30 days or 90 days. So either, yeah. So there's no deductible. So you have 0 deductible on your prescription plan. So you're going straight into copays. As long as the medication is covered under our formulary, you'll pay a copay. And that's how sometimes you'll know whether or not the prescription is covered or not. If they're charging you a lot more than what one of those 3 copays is, then you'll know that there's something going on and that it's not going to be covered. But as long as it is a covered drug, during the whole duration of the plan, you will only pay your copays for these drugs.
Thank you.
You know, Leon Wilson again, Orlando.
Mhm.
The problem I have is with this device is that a lot of prescriptions or drugs aren't covered. They don't cover the same type of drugs, even if they or they don't cover at all the same type of drugs that the current policy that we're under. Have that research been done to see if that they're kind of in line with the current insurance that we have?
So there's the biggest thing is it's not about necessarily the drug in terms of what it does. It's about the brand of the drug. That's the biggest difference. Is going to be that there's going to be a lot of drugs that are currently on, let's say the Blue Cross Blue Shield formulary that are high cost drugs. And for us, we wouldn't cover it, but we would cover a different version of the drug, a different brand of the exact same drug, a drug that is chemically equivalent to the drug that's currently on your thing. It would just be a different brand name of that drug. Because the biggest thing that we found out was that a lot of these drugs, they're high cost drugs, and there are multiple equivalents to it that are offered at a much lower cost. But what the pharmacy benefit companies are doing is that they are paying the high cost drugs because they're getting a much larger rebate from that. But then that rebate isn't always being passed on all the way back to the member. So then for you right now, as a self-insured plan, you are probably paying a lot more in pharmacy costs than what you should be, because what's happening is you're paying a larger cost for these drugs, and your pharmacy benefits manager is receiving a large percentage of that in rebates, and then they're passing on maybe half, maybe less of those rebates to you. So you're still stuck with a much larger bill. Whereas what we're doing is we're saying, well, we don't really care about the rebates. We take them into consideration, but at the end of the day, our drugs, the ones that we're covering, are based on which one is the lowest cost option, factoring in the actual cost of the drug and the rebate that we're receiving. Looking at all of that, which one ends up costing the plan less and which one is the most beneficial to the plan. Obviously, given that the drugs are equivalent. We're not going to look at one that works and the one that doesn't work, and the one that doesn't work is lower cost, so we're going to cover it. All about when we're looking at equivalence. And so the biggest thing is, yes, there's going to be some change, but for the most part, those changes are just getting them to drugs that are a lower cost, that are going to save us money. And in turn, when we save money, you save money, because if we have less claims that we're paying out with you being a fully insured group, then the renewal rates that we have to charge are less, so that's why we went to what we did. And that is the ultimate goal, is to be able to save money on these drugs by not playing the games that the pharmacy benefits managers want us to play.
So if I can interject, Orlando, with regard to the co-pays that are available with the TAC insurance, because we're a self-funded plan, I just want to let everybody know that as a self-funded plan, we can also move to the copay system if that's what everybody would like to do, if that's something that works out for us. We are not bound as under the self-funded plan. We're not bound to the current system that we have. We could use the same drug network that everyone is used to, but we could switch to a copay system too. So, as a self-funded plan, we can make changes as we see fit. So we could move to this, if we wanted to, as a copay for the prescription. So I just want to let everybody know that that is a possibility. And then we would be able to keep the same medications that we currently have.
Absolutely. And yeah, that's definitely a good point, because as a self-funded group, you guys do have a lot of ability to customize things as you choose, right? And that's the biggest, I will say that's the biggest positive of being self-insured, is that because you're paying the claims, you have the control to do as you please for the most part. However, the downside of it is you are paying the claims, so you have to make the decisions that benefit your budget. That's where a lot of the changes that we made that's why we looked at them, is simply just trying to say, hey, how can we reduce our cost? Everything that we do is in looking, and we work with consultants that are big time consultants looking at the drug companies, and so we work with all kinds of, we work with Navitus, we work with our consultants to really look at the formulary and be able to change it, and on an ongoing basis, not just one time a year, because new drugs hit the market all the time. So we always want to make sure that we're on top of those things, making sure that we're checking it at least every couple months, once a quarter, just making sure that we're not overpaying for anything. And and any time that we do make a change to the formulary, there's always a notification sent out to employees that are on that drug that's maybe moving tiers or going from covered to non-covered. So if there's any changes that happen, throughout the year, as they do, we definitely send out that notification, letting members know of the plan of action and kind of what their options are and stuff like that. So, as long as people check their mail, they should be informed on things that are going on. All right. Okay. Any more questions on the medical or the prescription?
Let me just for the benefit of the court and everyone in attendance, let's discuss the medical network. So the change for Liberty County, if we went with TAC, there would be no change to the network. It would still be with Blue Cross Blue Shield in the same network that we're in. Is that correct?
That is correct. Yeah. So we work with Blue Cross as well. So we are, you would have access to the Blue Choice PPO plan, which I believe is the same plan that the same network that you're currently on. So same doctors, same hospitals. The network wouldn't really change because we're looking at the same network.
Okay. We've talked about the medical and the prescription so far. the change for Liberty County on dental and vision, can you address that for us, Orlando?
Yeah. Absolutely. And so before I move on, I do want to mention that I think that it's let's see, what was it? The biggest thing is just making sure that we can make changes to this. So we offered you a plan that we felt, that eliminated a lot of your overhead, a lot of that risk involved. However, we can, if you wanted to see different options, so if you wanted to see lower copays on the prescription plan, we can work up those alternates for you. If you wanted to look at different deductible plans, different types of plans, if you wanted to look at an HRA, we can work up those alternates for you. This is a proposal that we put together based off what we felt we could offer, the best thing that we could offer. However, there's all kinds of changes that we can make. So if there's something that you're wanting to see, if you're wanting, like I said, different copays, different deductibles, stuff like that, we can work on those and we can get you those quotes as well to consider as part of this. This is just this is what we put together as what we felt was the best that we could offer.
Okay.
Okay, so then now moving to the dental. So the dental, what we did was we basically matched, we matched your current plan. So your current plan with the $3,000 maximum, $50 deductible. So no deductible for preventative care. So for all your cleanings and stuff like that, it's going to be covered at no cost. And then, 100% of preventative coverage is covered. Basic is going to be covered at 80%. And then major services is going to be covered at 50%. With an orthodontic benefit of up to $2,500, lifetime maximum per participant up to the age of 26. So it's basically, we customized this plan to match what you currently have. So the plan's going to be about the same. And then you see the rates there. So looking at the rates versus what you're currently paying, not much change to that dental.
You had mentioned something a while ago about liability being difference in being self-insured and fully insured.
Mm-hmm.
Correct me if I'm wrong, during this pandemic that we just went through, nobody knew what we was looking at or what we was going to go through, but I'm being told that basically if we'd have had 30 or 40 people in the ICU, it would have bankrupted the county under our current plan.
Yeah. Yeah, and that's the risk with any self-insured plan, right? Any self-insured plan, if you have a bad year, let's say you have, like you said, a bad year where you have a breakout and there's a large percentage of employees that end up in ICU, and now you have, instead of, I think your costs were, let's see, I think it was 8.2 million is what we calculated being your cost with claims and stop loss and all that stuff. So 8.2 million, let's say you ended up with a couple extra, high cost claims, a couple extra $1 million claims. Well, your budget then goes from 8.2 million to then 11 million, 13 million, something like that. And so that is the biggest, the biggest thing at looking at, obviously you have your stop loss coverage, but if you have a large percentage of your employees that go through something that really, hits you hard and you're maxing out up to the stop loss rates, and that's increasing, how much you're having to pull out, then yeah, I mean, it could completely derail you. And that's the risk though. That's why it's so important as a self-insured group to make sure that you're funding, funding correctly, looking at, the total claims and making sure that you're funding enough and that you have enough in reserves to be able to pull from if the worst case scenario happens. And then that's the difference in being fully insured, is that if every single one of your employees had, COVID and ended up in the ICU, well, you're still paying your premium. You're not having to come out of pocket more money because of that, because that's where the pool kicks in, and that's where we cover your costs. Now, you may be looking at a larger renewal next year because of it, but not anywhere near the amount of money that you would end up having to lose if you were self-insured. So that's the biggest difference between the self-insured and the fully insured, is that,
Just look at the plan that we have now, fiscal year 2020, we had to add $1.1 million into the pool because of overages. 2021, we had to add another $1 million $21 million. And then we had to write off 2.5 million for the year of 2019 for overages that were occurred by being self-insured.
Yeah, and that's where it's it's one of those things where is being the question that you have to ask yourself, which I can't answer for you, is it working for you? Is being self-insured working for you as a county for your budget? So I think that's the biggest question that you have to ask yourself is, are we doing this the right way? Are we funding it properly? Is it working for us or is it not? If it's not, then fully insured is the way to go, because you have your cost, you have your set cost, you know how much you're paying per employee per month. And you know that depending on how many employees you have, that's going to be your cost. So you're not going to have to be pulling money from the general fund to cover, different things. Now, the give and take of that is you lose that ability to do as you please and make those changes that you want to make because you're fully insured. So the decision maker in this case would be TAC. Now, that's not a bad thing because like I mentioned, we are governed by elected county officials. So, you can rest easy knowing that a lot of the decisions that are made within the best interest of the counties that we serve. So, we're not usually going to make any decisions that are going to hurt our members because, they're not elected officials aren't going to vote to hurt themselves. So, that's the biggest thing is that, the biggest thing about us is that if it comes down to, helping the pool or helping the counties, not, 10 times out of 10, it's going to be helping the counties because of that board that is always looking out for the counties.
Can you explain our laser claims? And I'm sure you're aware of them. And will there be any difference with your policy than the one we have with our laser claims?
Yeah, so we don't include any lasers in our plan. So it's fully insured, which means we take all the responsibility of your claims. So you're not going to be responsible for any claims. Now, again, that is starting January 1st, 2023. So any claims incurred after that date, you will not have any responsibility in paying those claims. Now, any claims that were incurred prior to 1/1/23, if you have runoff claims, those will still be your responsibility to pay. But anything that is incurred after our plan starts, we will be 100% responsible for, and all you will do is pay your premium. Same way, you can think of it the exact same way that you think of auto insurance and home insurance. If you pay your deductible, but you're paying your premium, they're not saying, oh, well, it actually cost us, $10,000 to fix your car, but you only had a $8,000 limit. So now you have to pay $2,000 of that. You pay your premium, you pay your deductible, and then that's it. You're not out of pocket more money. So it's the same way here. You pay your premium. We're not charging you anything extra for any claims. We are basically just charging you how much we believe it's going to cost us to pay your claims in this upcoming year. So a little bit more about that is, basically the way it works is we're trying to break even. And our break-even point is at 94%, a 94% loss ratio. Loss ratio being how much we've paid out in claims versus how much you've paid in contributions. Whereas most of the market, so Blue Cross Blue Shield, Humana, Aetna on a fully insured business, their break-even point is about 85% because they're building in profit margins, right? They're a business. They're in it for money. They're trying to make money. So there's more. They have less margins. So if you have a year where, let's say, you're at 94%, well, to anyone else, that could mean a 15 to 20% increase. To us, that's a good year for us because we're saying, hey, we broke even. Basically, we paid out all the claims and we paid out our administrative costs. And then at the end of the day, we didn't have any money left over, but that's okay because that is where we want to work in. We want to work in that zero profit. Just basically, that means that we've predicted correctly on what it would cost us to pay your claims. And then let's say you're running at 85%. Well, when surplus distribution comes around, you're going to get a good amount of money back because you've contributed more towards the surplus because we technically made money on you. So that money, doesn't come back dollar for dollar, but you will get a good amount back, knowing that, you guys had a good year. And then when you had a bad year, we're not going to go crazy and say, oh, you're going to, in my time that I've been here, and I've been here for about 5 years now, the largest increase that I've seen from a group over the last 5 years has been 12%. And that was a very, very bad year for that company, for that county. But other than that, I mean, like I said, we're averaging about 4.5% over the last 7 years. So, and we do have, and I didn't mention this before, but we do have a 9.5% rate cap for the second year. So the most that your renewal will be next year is a 9.5% increase. So we've capped it at that. So that is the most that you'll see for an increase for us. And most of the time, any new group that we get, they'll just, in that first year, they'll get the pool needed amount, which that pool needed amount on average is 4.5% over the last 7 years. And this year was 5.9%. So if, let's say you had come on January 1st of last year, and this was your first renewal with us, you would be getting a 5.9% increase this year.
So is this percentage, is it based on Liberty County's employees only, or is it based on the pool that we're put into that we have a better chance because of more people in this pool?
Yeah, so it's both. And that's a great question. So this is how we determine renewals. Okay, so we take the whole pool as a whole, right? And we say, how much money do we have to collect from the entire pool in this upcoming year? Once we have that number, that is what we consider the pool needed amount. Okay, that pool needed amount gives us a starting point. So this year, I'll use this year as an example. This year, our pool needed amount was 5.9%. At 5.9%, what we do is that is our starting point. So if you performed worse than the pool, so if we lost money on you and all this stuff, then you would receive higher than a 5.9%, depending on how much higher you did, your loss ratios and some different factors. And we also look into high cost claims. So the biggest thing that we look at is, where were these claims coming from, and are these claims going to continue? So premature baby is a high cost claims most times. However, for the most part, it's not going to be something that's going to be ongoing. So that number we can usually throw out and say, well, this is not going to be something that we have to collect for the next year. But let's say it's a cancer patient that has ongoing cancer. Well, that is going to be a high cost claim that we're going to have to continue paying. So we have to move that forward into the next year. But that is so then if you are losing money, you get higher than that pool needed amount. And if you're making money, if we're making money on you, then you get below that pool needed amount. So half of our groups are going to get this year got above 5.9% and half got below. And I want to say that the max that we gave out this year was like, I want to say it was like 9.9%. And then the lowest that we gave out was, I want to say we gave out a couple flats, a couple 0% increases. And in years past, and I will say, as you mentioned earlier, COVID has really kind of hit everyone, and we didn't expect it to hit us as bad. So for the past 2 years, this year was 5.9%, and then the last year was 7.3% increases. But then before that, we gave out a 0% increase. Then the year before that, we gave out a 2.8, and the year before that, we gave out a 2.9. So our average, taking out these past 2 years, is well below 4%. So in regular years, we've done really well in our renewals. And so when we have those low years where we're doing 2.8, a large percentage of our groups are actually getting decreases in their rates. And so we're not looking at saying, oh, well, in order to keep up with trend, we've had a good trend, and we still give out, in those years past before COVID, we were giving out 3-4% rate decreases to groups that were really performing well. And then the groups that are performing really bad, that might warrant a 20-25% increase, they may only be getting 10% at max. So that's where we look at the entire pool as a whole to kind of have a starting point, but then each group is based off their own merits in terms of, once we have that number, then depending on how you performed individually is where we either go up or down from that pool needed amount.
Orlando, if I could just add to something that you mentioned earlier
Yeah.
with regard to Commissioner Kowalski's question on the laser. So you're not suggesting that the lasered individual is excluded from coverage. You're suggesting that that cost has been built in to your proposal. Is that
That is
correct?
That's correct. Yeah.
Okay, so with
we
regard
assume
to
the full
that,
responsibility
with
of-
regard to that $1 million that you built in to your proposal, in the event that there is a cure or God forbid, a death with regard to that, would there be a credit issued on our premiums to account for that difference that's already built into the premiums?
So there wouldn't, so let's say that there is a change and that $1 million claim is no longer on there. We wouldn't necessarily just say, okay, well, we're taking off $1 million of your claims and we're just going to, re-rate completely and just take $1 million out of your total funding. What we would do is we would say this claim is not moving forward. So excluding this $1 million, how much money do we project we have to collect from this group to pay out their claims moving forward? So it's not a dollar for dollar thing where you're going to see $1 million taken off of your total premium that you're paying for the year, because we still have to account for, well, this person's off, but then next year, there's some claims that just started that are going to be high cost claims. So at the end of the day, it's all about projecting. And we work with actuaries that have, the state of Texas and, the UT and A&M. And so they work with the majority of employees in the state of Texas, I would say probably. And so they are very, very good at getting us very, very accurate predictions on what they think that our costs are going to be. So utilizing the information that they give us and utilizing, basically your information and projecting is kind of how we come up with your rates. So yeah, so if that $1 million claim does come off, then we may see a smaller renewal amount, because we're saying, okay, well, that was $1 million claims. But I will also tell you, we also have stop loss coverage on our pooled groups. So we are also paying, we aren't paying the full brunt of $1 million claim because we have stop loss coverage on it. So it may not end up being $1 million that we're taking off. It may only be, depending on what our stop loss coverage is, I think it's like 900,000. So we only may be taking off 900,000 on that because we have stop loss for the rest of that coverage over 900,000. So that's why it's not necessarily always a one-to-one dollar. It's always going to be us just trying to project how much we have to collect every year to pay your claims, and then factoring in the fact that what is the trend, the medical trend in the industry in terms of how much are costs going to go up from last year to this year. So that's why it's not necessarily a one-to-one thing, but it is definitely something that if that claim came off, you would see something different. Definitely we would see something different on our end when we're looking at your renewal.
Okay, thank you.
So in basically layman's terms, if you're insuring a bad driver this year, and that bad driver got better, the next year the rates are going to be lowered.
Not necessarily lowered, so you're not going to necessarily see a reduction, but it would be lower than what it would have been had that person been on there. Assuming that you didn't get another $1 million claimant that came on to replace that $1 million claim. That's why it's very hard to project and to predict, because you may have $1 million claimant coming off, but then you may also have $1 million claimant coming on, or you may have a $2 million claimant coming on, which means that instead of reducing the cost, we're now going to have to increase the cost, because we're saying now we're having to pay $2 million for one claimant instead of $1 million for one. So if everything is the same and you lose a $1 million claimant, then yeah, you should see lower than what you were going to see had that $1 million stayed on. But that doesn't necessarily mean a reduction in premium in terms of getting a negative renewal amount instead of a positive, if that makes sense.
Andy, do you have any questions?
Orlando, I got one question for you. This is Judge Knight. 254 counties in the state of Texas. How many counties do you insure at this time?
So we insure 185, I believe, of the counties are in the pool. And our total pool has about 231 different groups. That includes appraisal districts, emergency service districts, water districts, and so some other districts, but 185, I believe, of the counties are in the pool.
That's 185, like 185, right?
It's 185.
Okay. How about municipalities, just out of curiosity?
We don't have any municipalities.
Okay.
Yeah. So there's another pool, which is TML, and
Yeah.
TML is the one that deals with municipalities, and we deal with counties.
She's on another call right
Okay.
So y'all mainly deal with counties in the
Counties,
Texas
yeah.
Association of Counties.
Yes, correct.
Just want to get that clear.
Or county entities. So county appraisal districts, county emergency service districts, and stuff like that. So we have some county hospital districts as well. So it all boils down to counties, right? You know, if they're not associated to a county in some way, then we won't work with them. And the good thing is, for counties, we will basically work with most counties if they want us, with different special districts. So like the appraisal districts and stuff like that, like we will only work with them if they're a good fit, you know? So we are very, very strict on non-county groups that are, you know, obviously one, they have to be associated to a county, and two, we look at the underwriting. So we look at, are you performing well? Do you have a good number of employees that, you know, we can spread the risk to? Because the biggest thing that we're trying to do is this pool was created for counties. The different entities, the different, entities that we're talking about, we were not necessarily created for them. So what we try to do is we try to bring in the best of the best in that category to booster the pool and not to bring it down. So we are very strict when it comes to our underwriting requirements for those districts that are not counties, just because we want to be good stewards of the pool, and we want to make sure that if we're bringing in a group that is not a county, that they are adding to the pool and not taking away from it.
Orlando?
Are you
Sorry.
currently insuring any counties that are either of like size, like health financially and health wise, and then that are contiguous, at least to our area in Texas?
Yeah. So now employee size number, I don't know exactly what you're off the top of my head, but I do know we work with Orange County. They're in the pool and they've been in the pool, and they're actually, you know, they're one of our success stories in terms of, you know, one of the groups that was just kind of always performing not as great as we would hope. And they kind of turned it around. And so now they're really performing well. So they're one of them. Hardin is in the pool as well. Let's see, Waller County as well. San Jacinto, Polk, Tyler, Walker County as well, Grimes County. Brazos County is in the pool as well, but they are self-insured in the pool. Same with Harris County Appraisal District. They're in our pool, but they're self-insured. So we have Brazos County is about 900 employees, and Harris County is about 600 employees, and they are both self-insured within TAC. But then the other counties that I mentioned, Washington County as well, they're all fully insured within the pool.
Okay.
And we also have Galveston. Galveston's also self-insured as well, and Chambers County. I'm looking at the map right now. I'm looking at what's around you guys and seeing who's in the pool or not. But yeah, and we can provide you guys a list of those counties as references, and just let you guys reach out to them and kind of ask them the questions that you have on TAC. You know, if that's something that you guys want, we can definitely provide that, and that way you guys can do your own due diligence and see what they have to say.
Okay, thank you.
Do you just want similar size groups or just groups in the area?
I think similar size, you know, not so much the areas as the total number of employees.
Yeah, we can get you some that are in your area. I don't know how many employees do you guys have? I can't remember off the top of my head.
About 500.
About 500. Okay. Bastrop County has about the same number, and they're in the pool. We can check to see what other groups. Tom Green, I think, is also about 500, and they're in the pool as well.
Okay.
So yeah, we can definitely get you guys a list of groups that are of similar size that are in the pool, and then kind of get you the information for, you know, who their contact person is, who would know most about TAC. And that way you guys can reach out and kind of ask them questions, and, you know, let them, you know, answer questions for you about the pool.
You were saying that other counties are self-insured with you. Did I understand that right?
Yes,
So
yes.
my question would be, if we became less than desirable for you guys, you know, a year or 2 years down the road, because you gave us a rate cap for 1 year, then what are our options with you?
So you won't necessarily become undesirable. I will tell you that because we've had groups that have had a really bad stretch of bad luck. So, you know, at the end of the day, that's why you're part of a pool, right? That's why this pool was created, was to, you know, for smaller groups that, you know, kind of get, you know, mishandled out in the market on their own, for them to join something that's bigger, where they're not, you know, receiving those large increases, based off of, you know, one bad year, let's say, but also larger groups that, you know, may have a couple bad years. And then that way the groups that are performing well are kind of lifting them up. And then the hope is when those groups that have been lifting up that one group or multiple groups have their bad years, that the other groups that have been being held up will then also do their part on holding up the other groups. So we don't necessarily have you know, we won't non-renew you. We won't say, hey, you know, we're not going to offer you coverage this year. You may just end up getting at the top of our renewal increases, which, you know, usually the top of our, you know, increases are about 10%. So even in a bad year, you know, if you might get a 10%, you might get 12%, but you're not going to get a 30, you know, you're never going to get a 30% increase from us. And I think that's the biggest thing is, if you're having bad luck or a bad run of years, being self-funded is the worst thing you want to do, right? Because then you're just on the hook for more money. You know, usually when we try to not talk groups into it, but, you know, when we really have those conversations with groups that want to go self-insured, the biggest things is, one, you have to have enough employees, because if you are a 20 employee group, self-funded is not for you. You know, you're just one bad claim is completely going to derail you. So if you have more employees, you have more to spread out those high cost claims if they happen. But the another thing is, how have you been performing? Have you been losing money in terms of like, oh, you're paying in a lot more than what we're paying out in claims? Are you running at a 60% loss ratio versus 140? If you're running really well, basically you guys are losing money, you know, in that case. And then that would be a situation where we would say, yeah, you know, you definitely have a track record for the past 3 years. Let's say you've been running at about 70%. So you very easily could go self-funded, because you are going to save money by going self-funded, because you're paying the claims and your claims aren't as high as what we're collecting in premium. But if we're collecting $8.6 million in money per year, and we're paying out $10 million in claims, going self-funded, all that would do is say, instead of now paying 8.6 million, now you're going to be paying 9 or 10 million. And that would not be something that you should do, you know, obviously, because that would add to your budget. So those are the conversations that we have in terms of self-insured versus fully insured, is just making sure that you're aware of, this is going to increase your total budget, and it's going to increase your total risk, which is the conversation we're having here of, you know, fully insured, we're taking all the risk out of it. You budget what you budget, and there's nothing else that you have to pull out after that.
And again, I will state that the last 3 years being self-funded, we have had to take $4.6 million out of our general fund that was not budgeted because we was self-insured.
Yeah. And that 4.6 million would not have been the case had you been with TAC fully insured, or not just TAC, but had you been fully insured in general. You pay your premium and then that's it. So that 4.6 million would have been saved had you been fully insured during that
time. Anybody got any more questions? We do have another it's like workshop, special meeting. After this one, we've kind of gone over a little bit, about 20 minutes over into this one. That's okay. I don't mind that. I'll stay here all night. That's what it takes. But the main question is, if anyone has any questions, I would say now's a good time to ask.
And I will say, I would love for Ashley to get a couple minutes just to talk about Healthy County and the purpose of it. So if I can, I'll just pass it off to Ashley to kind of talk a little bit about Healthy County, and then we can answer any final questions.
Ashley, why don't you, he's up here.
Orlando, thank you.
Ask, what makes it easier? Should I come?
Just whatever's more comfortable to you. Yeah.
Okay, I don't know.
I will say, Orlando touched on that. They asked him to give us a quote, gave him the treasurer's office for Gallagher, what we currently have, tried to mirror it as well as you could, but changes can be made.
Yeah, that was pretty obvious. Yeah.
Okay, just to kind of give an overview, as far as Healthy County, it is the wellness program. It's a comprehensive program that we have. Since you guys do have Blue Cross right now, you do continue to get the well-being management portion of it. However, there are some other programs and benefits that we do include with that are at no additional cost. As if you were to remain self-insured, that's an additional admin cost that you would have to pay for those. What we do on our side is more so looking at programs that's going to help reduce the overall cost for employees and also for the plan long-term. So there are different things. If you do have a copy of the proposal, there is the Healthy County Resources Flyer, which is what Orlando is showing on the screen as well. One program that we do have an offer is a physical activity platform. We utilize Sonic Boom right now. With that, we do have contests that we host over the year. Employees are incentivized for participating in those contests. We also do have a device storefront as well if they want to get a device with that too. So that is one of the value added benefits that comes with TAC through the Healthy County program. Another thing is Livongo. Do you all utilize that now? Okay, so with Livongo, Omada, and also Wonder Health, those are three of our management programs. So with Livongo is going to be there to assist members who are managing diabetes and high blood pressure. They do get their test strips and lancets covered at no cost. That is an added benefit with that program. Also a glucometer and a blood pressure cuff for that too. With Omada and Wonder Health, those are two of our weight loss, weight management programs. They're both online, no out-of-pocket costs for employees to participate in those too. So those are some of the things that we do have. You also get myself as far as just the educational component of it. As Orlando said, we do believe that education is key. So whether it's understanding what your benefits are, how they work, how to best make them work for you, as well, but then also different tips and tricks and things, different topics related to health and wellness, whether it's financial wellness, stress management, all different types of things. I'm able to provide that education to employees on too. So if you just review those or review that flyer as well, it just kind of gives you that overview on that. So just know that that is an added value that comes with that, all of the different incentives with Blue Points. And then also, like I said, we provide those additional incentives through our program too. So like I said, long-term strategy, we can talk about putting in wellness plans in place. Therefore, that does give employees a little more skin in the game of one, managing our health at the end of the day. So whether it's an annual exam that's covered at 100% of preventive care, just so that way we know where we are with our health status, and that way we're reducing that likelihood of having a catastrophic or high cost claimant at the end of the day. So different things that I do like to come in and understand what the culture is here. So that way I'm not throwing a whole bunch of stuff at y'all and you're like, oh yeah, no. So I do like to have that relationship and making sure that we're able to put in place things that work for you guys as well. But if you do, I have some of my cards as well, if you want to have any other questions about that too. So Orlando and I work hand in hand with making sure that your entire benefits package is what fits the need here for Liberty County.
Yeah, just comparing apples to apples. If you were to be the chosen one for our insurance needs, you might be ready to just move on down to Liberty County, and we'll get you a place to stay.
Okay, I'll be ready.
Because folks are gonna have a lot of questions. You talked about the educational aspect, and that's one of the things that is really important with making a change like this. People are not gonna believe anything that we say. They'll believe what you say. And even though it's taken us, well, I've been here for 8 years, and it's taken 8 years to get everybody to where it's like, okay, we're fine. You got something better? Okay, fine, show me. That's the way it is. And a lot of questions. People ask a lot of questions that don't deal with this every day on paper, if you know what I mean. When they go to the primary care physician or whomever, they want to walk in there and say, here's my card, fix me.
Yes.
And I don't worry about what it costs until they start walking out. You know what I mean? Okay.
Yeah, so we definitely will dedicate time. You know, how many of our workshops or trainings, Road and Bridge normally starts early. If you want to do that, we've done 6 a.m., 7 a.m. start times, and then gone throughout the day to try to catch shift change from the sheriff's office. So we're here at the end of the day to be able to assist you guys with that transition.
Leon, you got any more questions you can think of on this particular part?
No, I don't have any at this time.
Okay. Greg?
Yeah, I'm good.
Bruce?
I think so.
Good. HR, y'all got anything? Him? She's still celebrating Aggie's winning Saturday.
No, sorry. Excuse me, I muted myself.
Yeah.
Judge, I have a million questions, but I think it's late in the day and everybody probably wants to move along. So I can reserve those for later. But I do want to say to Orlando that I really appreciate TAC putting this proposal together. I know that Harold probably has a drawer full of letters from TAC saying that they declined to bid Liberty County for multiple years in a row. I'm not sure why that is and why we were lucky enough to get the proposal this year, but I'm really glad that we have it. And I think it's important always to have options. This appears to be a really good option. Again, like I say, that lots of questions, and it's a big move and a big change from what we've been doing for, I know at least the past couple decades. But I thank you and I thank the TAC team for putting the proposal together for our commissioners to have a look at.
Matthew, I see you're on there. You got anything in particular?
No, I'm good.
Okay. All righty. Penny, y'all back there with Insured Healthcare guys. Okay. Anything? Didi? Catherine, come on.
Definitely not.
All right, I'll say the best for last. Angela, what you got?
Well, if you could go back over page 19 for us and just outline the major differences in the dollar amount.
Yep.
So that we can ponder that and think about it, because we have other things besides the dollars on this page that feed into these numbers. And so the difference is even that you're showing maybe less than what it is, but we just I want to get a clarification on that bottom line in case we come back to this over the next day or two.
Yeah, absolutely. So this is something that we put together. It's a spreadsheet that we can send to you. It's an Excel spreadsheet. That way, if our numbers are wrong, and you can input the correct numbers. But this is basically what we put together in terms of what we're looking at is your total fixed cost that you currently have versus the total fixed cost that you would have if you went fully insured. So when you're self-insured, you're looking at obviously your projected claims. So you have to look at how much, how many claims are we going to have? What's that total going to be? The maximum, 125% of what your projection is. Then you're going to have your admin fees. So your admin fees that you pay to Blue Cross Blue Shield to administer your self-insured plan, your broker commissions, your stop-loss premium. So obviously, you guys have your self-insured that you're paying, your claims for, but then you also have your stop-loss coverage, which covers any claims over X amount of dollars, depending on where that limit is set at. And so you're paying stop-loss coverage. You're also paying run-out claims, the administration of that. So this is just kind of looking at, and your HRA administration plan. So how much money you're actually paying or having a budget for every year to fund that HRA. So that is what that amount is basically just looking at all those costs that based off of the information that we were given, kind of looking at how much your budget would necessarily would be, looking at all those fixed costs. And then looking at, obviously you see a lot more different numbers on the ASO side than on the fully insured, because as I mentioned, on the fully insured side, we basically just take how much you're paying in, which is those rates that we gave you, times the number of employees that are in each tier, multiplied by 12, and then that's the total amount that you'll pay in the year for us. So that blue number on the fully insured side, that is pretty set based off our rates and your current enrollment. Now, obviously, that number can change if you have members go from employee only to employee family and stuff like that. But for the most part, based off your current enrollment, that is what our number is going to be like for the year. Versus, as I said, we can send you this and then you guys can plug in, whatever numbers are accurate and then see what that difference is. But it's basically just a tool to help you, going from self-insured to fully insured, really understand what is the price difference going to be for our budget.
All right. Anything else? Okay. 'Cause I'll,
Judge, I'm sorry, I had to unmute myself. I have a question on, so the fully insured appears to be, not just under $400,000 higher for this year. But in addition to that cost, it says the county has no liability on the fully insured side with regard to the run out claims. But we would have to pay our run out claims from the 2022 coverage. So that would add another $435,000 to it, which would make the total fully insured cost for the 2023 year
Liability after this year.
approach or exceed $9 million. Is that correct?
So
We wouldn't pay
amount you're gonna have
TAC
to
$9
do-
million, but we would pay TAC 8.6, and then we would pay the $435,000 in run out claims from our 2022 coverage.
So technically I would agree with that. However, I will say that run out claims you're going to have regardless of whether you move to TAC or stay, those claims are staying. You're still going to have to pay those. So moving to TAC, what we say the county has no liability is any claims moving forward. So let's say you move to TAC and then all of a sudden in 3 years, let's say you decide to move from TAC and go somewhere else. Well, you're not going to be paying run out claims at that time because you'll have been fully insured with us. So you won't have any responsibility for any claim.
And correct me if I'm wrong, since we're making this transition from self-insured to fully insured, this lapse of time of 3 months that we'll have to pay extra, this will only happen in this transition. It will not happen next year.
That is correct. Yeah. So this is just any run out claims that are incurred. Obviously, let's say someone has a claim on December 13th, but that doesn't get billed until, February 1st. Well, that was incurred before you moved to TAC. So you would still be responsible for that claim. But any claim that happens after January 1st, if you move to TAC, you will have no responsibility of paying any of those claims.
So that the $8.6 million proposal from TAC is basically I guess what you'd call an immature plan year because it doesn't reflect, the ongoing costs from the prior, say, fall claims.
Correct. But those run out claims usually, you won't go more than 6 months paying. I mean, normally you won't be paying those more than 6 months out after the plan year ends, because usually those claims are processed pretty quickly, or they're sent off to be paid. So it's not something that 3 years down the road you're still going to be seeing claims coming in from when you were self-insured. So yeah, so I mean the goal is that this plan, and I think your published funding for 2022 was about 9.1 million. So we looked at your cost of what we basically looking at the numbers that we were given, and that's where we came up with our number. But it looks like your published number for funding was 9.1. So if we look at that number, that is actually going to be less than our fully insured would come in less than what you're actually budgeting for. And to I think it was Commissioner's point, where every year in the past couple years you've had to pull out millions of dollars out of the general fund. So these numbers is what you're funding, but then when you add in the millions of dollars that you've actually had to pull out from the general fund, you're actually saving money based off even if the average is $1 million a year that you're pulling out, that takes that number up to 9.2 million, and we're at 8.6 million. So we're still below that of what you're actually spending, not just what you're budgeting for.
All righty then.
Thank you, Orlando.
Orlando, thank you for visiting with us. Sure do appreciate it.
Yeah, not a problem. I have hopes that, when I'm over COVID, I will visit you guys again in person, and we can have a conversation in person.
I'm sure we're going to get that opportunity for it. It's all okay. All right. We'll probably have some more questions for you. Give everybody a little chance to regroup. And
yeah, I'm happy to, you guys have, if Harold has all my information. So if you guys don't have it, and it's in the proposal as well. So feel free to email me, call me. I'm happy to answer any questions that you guys have. If you are wanting to set up another workshop at some point to maybe go over additional questions that you have, I'm happy to do that. Or if you guys are looking at wanting to see some alternate options from us, just let me know what you guys are looking for. I can put it together, send it over, and then we can have a workshop to discuss those. I'm open for you guys, and I'm here to help. And even if you guys don't move with TAC, I'd love to be a resource for you guys in the future, and just kind of be able to help you guys as much as I can.
all right. All right then. Well, let's close out this particular meeting. We got one more to do, so it shouldn't take quite as long. But anyway, just letting you know. So it's about 5 minutes after 4, and we'll move along. Thank you so much again, everyone. And if you're on the invite, let's go around. Well, please stay close by. We'll get you zoomed back in. Such.
What are we going into now?
We have a insurance.
Judge,
Yep.
that insurance committee meeting is actually on a different platform. It's through Teams, I believe. So we may have to make some adjustments on that. I didn't know if you wanted to go ahead and let Gallagher have the floor now before we move to that meeting or not.
We can.
That might be easier, because I think we might have some trouble switching over on to the insurance committee meeting.
I got you, since it's on Teams. Yeah, let's go ahead. And Chuck, I know you're probably with us. Am I correct?
Yes, I am. I'm here.
Good.
Can everybody hear me okay?
Yeah. Why don't you, I'm sure you've written some questions down. Why don't we just go ahead and weigh into them right quick?
Absolutely. No, I mean, and I think, a lot of the stuff that Orlando went over, touched on, how their benefits operate. The thing is, the self-funded plan that we currently have in place, the plan design is significantly different than the fully insured option that they have provided. Orlando mentioned that they can provide other types of plan designs. When looking at the budgeted cost, I did put together, I'm going to see if I can share my screen here. I've got the proposal from TAC, as well as, I think, this here. Share screen. Everybody see my screen here?
Yeah.
Yes?
No, but I
Nope,
did
I just
just see that Commissioners Court is the host now, so that may be affecting it. There you are.
Okay, no, I clicked share, but there was one more share I needed to click. I think it might be helpful just to kind of illustrate just how the different plans work. And, you know, this here kind of shows you side by side how Liberty County's plan currently is structured from a self-funded perspective. And so you've got 3 different sets of fixed costs that we currently pay Blue Cross Blue Shield of Texas. There's the administrative cost, which is essentially paying them to adjudicate the claims and gives us access to their network. So that Blue Choice PPO network is the same as what we have if you were to move to TAC. And then you have 2 different types of reinsurance. So the key point here is that Liberty County is not truly self-funded. You are partially self-funded, which means you pay most of the claims, but you have 2 different types of insurance policies. Your specific reinsurance policy is that kind of like your home insurance. When you've got your catastrophic claim, you have to pay 2%, and then your homeowner's insurance picks up, you know, everything over and above that deductible. For your specific reinsurance, Liberty County's stop-loss is set at $150,000. So any claims that are in excess of $150,000, that reinsurance policy pays out each year. We do have that lasered individual that we had talked about, and that individual, the county is on the hook for this year for the first $1 million worth of claims that are incurred, and then anything that are paid out during the calendar year for that individual above $1 million would be reimbursed under that stop-loss policy. And then the claims. You got the medical claims, the RX claims. Those are going to be the claims of the claims. That's how the plan is running. And the potential savings that you have when you're self-funded is, based on that estimated, expected cost. You're fully insured. They charge just a one premium, and if you're self-funded, there's a lot of years where you may actually reap the benefits because you're coming in under what you'd be paying as far as a premium. But then there are years when your plan runs, more than expected to where you exceed those projected costs, and then that's where your potential risk is. There are some things to consider when you're looking at, the pros and cons from a self-insured versus fully insured. The pros, you've got, you're removing those insurers' profits. Now, I think Orlando kind of indicated that because they are an association for counties, they're not trying to make a profit, that their loss ratio, their target loss ratio is higher than what a fully insured, Blue Cross Blue Shield, Aetna, Cigna, United Healthcare would be looking for. But you're still trying to cover those costs. The biggest positive from fully insured is the consistency from a cash flow perspective. You're able to clearly budget based on the set cost that's there from an employee only, employee and child, employee and spouse, employee and family. However, it is still a function of how your plan is running. And if you're running, a portion of the fully insured cost is based on your experience and your credibility. And then there's also how is the pool running? How is the fully insured, book of business for the insurance carrier running? And those are going to determine what your costs are each year. You have less control over what those costs are when you're fully insured and going into your renewal. So you've got your rates set for the upcoming plan year for 2023, but then going into 2024, depending on how the plan runs, if you've got some higher risk claimants, that may be factored into setting those fully insured rates. Self-funding does give you the ability to have a lot of flexibility in how you set the plan designs. We've not made any plan design changes to Liberty County's plan designs for quite some time. We have looked at cost savings matrix, where if we increase the deductible, we change the healthcare reimbursement account funding. But one of the things we also can do is we can take a look at some of the coinsurance versus copays. So I've gotten some feedback as far as the prescription drugs. You pay a percentage of the costs after you've met your deductible, but if you use up your HCA funds, you may be paying 100% of the cost for that prescription drug. Part of the reason that plan design is in place is because employees that are spending money and seeing the full cost of those prescription drugs may choose to take a look at those alternative therapeutic alternatives that are a cheaper option, which helps drive down costs and drive savings under the plan. But it can be somewhat disruptive when you're having to pay 100% of the cost and you've not realized you've been paying that the cost of that medication is $400. But I think it's more about educating employees about how those plans, what options are out there for ways for them to save the money in their pocket, before they've used up their healthcare account funds, and then also after they've used up their healthcare account funds. As far as just comparing the plans, and I went through tax proposal and tried to kind of highlight some of the differences. And like I said, I'm going to see if this, oh, it went to the wrong screen. Let me show. It's kind of hard to see. The plan designs are completely different. We've got a $3,000 deductible on the current plan design. Tax plan is going to be a $1,500 deductible. You've got a lower out-of-pocket maximum on tax plan, but those healthcare reimbursement account funds are first dollar. So those pay in the event that individuals have claims. It comes out of that $1,000 and that $1,500 cost up front, and then once they've spent $1,000 or $1,500, then the plan is going to pick up, start sharing that cost with the employees. So there's a lot of employees that are currently enrolled in the plan that aren't even spending the $1,000 or the $1,500, and they have those funds and they're rolling over from year to year.
So Chuck, let me stop you there. If
Yes.
we were to move over to TAC, they do or they don't have an HRA mentioned in their proposal, and would all of the employees who have balances in their HRA then lose those?
That's a very good question. I don't know how the county would want to handle those that have balances, but the current TAC plan does not have a health care reimbursement account available under that plan. And so that would be a consideration that you would need to take into, factor in when making the transition for those that have funds in their healthcare reimbursement account.
If I'm wrong or right, I'm not sure, but I think that whole idea of the HRA was because the deductibles were so high and there weren't copays. And now there are copays and lower deductibles. So that's what you said. It's going to be a decision that the commissioners will have to make, but there may not be any HRA anymore, if those were the reasons that they started it.
Correct. So I think, typically the way that I would approach, when requesting plan designs, I usually ask for, an apples to apples comparison. I don't know if TAC can provide a quote that matches the current plan design, so you can get an idea as to how they view that from just purely the same plans. So we're comparing apples to apples, and then you start making the changes in how the plan design operates. We can add copays for the prescription drugs and remove those coinsurance, but that's going to add costs. You're going to have additional costs, that the plan will incur if you change the, you're essentially shifting or taking cost from the participants and just putting a $10 copay or a $50 copay or a $75 copay. Our underwriters can model that. We can have them put together a projection based on mirroring tax plan design. But we're kind of comparing two separate types of plans. You're going to be shifting costs to the plan. When you're reducing the deductible, reducing the out-of-pocket, you're saving costs to the plan by removing the healthcare reimbursement account. So there's a lot of pieces that are moving in that perspective. When it comes down to how the plan has been running, if we just look at the Blue Cross Blue Shield self-funded plan, we budgeted that 9.2 million. That was based on the budget numbers that had been put into the budget for 2022. They did not actually, those were not the projections that we had put together from an underwriting perspective from Gallagher. We use the same methodology that TAC does, as well as Blue Cross, Cigna, Aetna, United Healthcare. When looking at the claims and factoring in the experience year over year, but we're looking at about a $700,000 decrease from a projection perspective. So that's the expected plan cost. So if it runs as we're expecting, the projected cost for the upcoming plan year based on the negotiated renewal with Blue Cross is a decrease of $706,000 over what we currently have budgeted for the 9.2. If we compare that 706,
Was that including the one-time credit that we were getting?
that does include the one-time credit. That's got the $200,000 credit that Blue Cross came back and is adding and taking off that first month's admin. So Blue Cross agreed to lower the laser from 1 million to 800,000. Some of the marketing efforts that we got back gave us some leverage to push back on the laser. The large claimant has not been incurring $1 million in claims each year for the past 2 years, and it's been closer to about 700,000. And so we were able to get Blue Cross to lower their laser from 800 or from 1 million down to 800. So that's not necessarily a tangible true dollar savings, but when we work up our projections, we do factor in that full cost of that laser, even if that's not necessarily likely that we would hit that amount. So if you look in the middle of the screen, we've got a projected savings of negative 5.5. That's including $1 million laser. When we remove that $200,000, that comes off of our projection and then shows a projected cost for 2023 of around 1.5 million. I mean 8.5 million. And that includes your fixed costs. That's the admin costs, your specific stop loss, your aggregate stop loss, and your claims costs.
Administration fees, is that including Gallagher's fees, or does that come out of the pool as claims come in?
So our fees are baked into, there's a PEPM cost built into the admin, and then there's also a percent commission built into the stop loss. The fees that TAC are showing also includes $18.50 per employee commissions, and that's, I think, outlined in their proposal.
And that's not shown on the 8.274
the 8.2
comparison with the
you're comparing it to this
8.6. Sir.
So yes, I think the difference here is actually the head count that we're using. So the 452, they pulled that from the census that was sent out with the RFP. The numbers here, we're showing about 8 more, but it's a function of, these are the numbers that were included with Blue Cross Blue Shield's renewal. So we're showing 460 versus 452.
And does this cost not include the SHA?
These do, our projected costs do include the healthcare account dollars that are used throughout the year. So not every individual uses the $1,000 or the $1,500, but the claims reporting that we get includes the HCA funds that have been used.
Does this figure
it's built into the workup?
Does this price include the $270,000, $280,000 we're paying from Foundation a year, above and beyond?
It does not, because that is not running through the self-funded medical plan. And I'm not sure what the intent is as far as maintaining that relationship if you move to TAC, but that cost would still be there if you continue to use the county firm foundation contract with the Blue Cross self-funded plan or with TAC.
That's no reason to continue using it.
So without the $200,000 difference, that one-time credit that Blue Cross threw out there, the projected costs for the self-funded plan and the all-in cost that based on the enrollment and the rates that TAC provided, they're pretty close as far as the projected costs. But then you do have that one-time runoff cost, the administration. So you've got a hose full of water, and when we shut off the faucet, you still have everything that's in the hose that still has to be paid out. That's on the hook for that self-funded contract. So Blue Cross charges a $15 and 32 cents per employee per month for that runoff administration, and they'll administer the runoff claims for 12 months after the plan turns off. So if you leave Blue Cross and starting January 1st, 2023, you're with TAC, you're going to pay the $15.32 per employee per month times the number of individuals that are enrolled in the plan, employees and retirees that are enrolled in the plan as of the last 3 months of the plan year. So we're assuming that 460 times the 1532 times 3 months. So you've got a run out administration cost of just over 20,000. And then I'm using the number here that was the estimated run out expected claims cost of that 435,482. That was, I pulled that actually from tax proposal. So if you look here, this green box here, this is the expected run out claims cost. So those costs would be, falling within the budget year of 2023 for Liberty County, and would be included in addition to the cost that TAC has from a fully insured perspective.
Which would still be a lot less than what we're doing right now. Like I had stated before, in the last 3 years, we have had to take 4.6 million out of our general fund that was not budgeted during those 3 years on our current plan. So the runoff,
I do think,
not looking at $500,000 on our runoff, even if we had to pay out plans.
so I'm, not counting the runoff, I'm seeing, based on the 460, about $8.7 million in budgeted costs if you were to go with TAC and the proposed rates that they have based on the enrollment that I'm showing here.
Right.
If I look at from the claims reporting that I've pulled historically, this summary for 2019, we had gross claims of 5.3, fixed costs, your total plan costs after you got reimbursements was about 5.7, 5.8 million. Your cost did go up in 2020 with fixed costs. Your actual cost for that plan year was 6.6. For 2021, it's 7.7. And then through July of this year, we're on track for 4.2. Now, a lot of that has to do with the fact that you've had a significant increase in headcount. We took over the employees from the jail. You had 345 average enrollment in 2019, 378 average enrollment in 2020, and 423 average enrollment in 2021. And we're up to 448 average enrollment so far this year. So I think I still am unsure as to why we were so far off from a budgeting perspective and how the county has been budgeting for it. But I don't necessarily buy into the fact that it's going to be cheaper for the county to go fully insured. If you use the budgeted numbers that we're looking at here, we're budgeting and we're projecting 8.5 million based on the current headcount. Now, did we dip into the general fund because we had increases in individuals on the plan, and there was a lot more people, and that was driving a lot of the increase?
We have unfunded things that are not mentioned on your chart, and I think I talked a little bit about it in the last insurance meeting.
Yep.
We have foundations that's being paid out of the benefits and insurance. We have Plan Source. We have a number of other things that are flowing through there that are also getting paid out of there. So when you just look at the premiums, that isn't showing what we are actually paying as a county on a self-insured basis. And I think we did a lot of that to make our self-insured rates hopefully stay down. And so I think just so you understand, that's what we're talking about. It's not what you're seeing on your charts. Your charts are probably great. But we have other expenses running through that, benefits and insurance, that are in addition to these premiums.
And are occurred since we are self-insured that we would not have if we was fully insured.
So, and, you know, from a Plan Source, the county health clinic and some of those other initiatives, those are all separate from. And then the question would be, you know, are you going to continue those costs if you were to go fully insured? And I think that's, those costs aren't going to go away just by switching to TAC. You would be making changes to, you know, those exist regardless of whether we stay with Blue Cross and stay self-funded, or if we go through and we're on with TAC on a fully insured basis.
And I want to say that some of the debt that was there had been accruing over time from I know it was there during 2017, 18, 19. It took us a long time to pay off the cost that the self-funded had actually cost us over time. So I think this year looks good, but I think in the past, it was not good. That was just debt that was on the books for years. I don't know how long, but it was here when I came in 2017. And we were having to pay money out of the general fund to get that debt gone. And it's finally gone. And then we are somewhat funded now. But we're looking at what all happened in the past, and if we have a chance to not have that happen again.
And as I stated, being self-insured scares me. As we was little, now it was fine. But, you know, I hate to keep coming back to this pandemic. It doesn't mean that we're not going to see another one. And when you have 30 or 40 people out of 400 that may be in ICU, and there's a possibility that it bankrupts the county, is a concern to me.
Well,
So
that's things we're going to have to consider. Chuck, I will say this, as far as the side of what the self-funded versus fully insured and things that happened in the past, that's not even relevant right now. Don't even consider that. Throw that out the window. That is old business that happened in the past. What we're looking at comparatively is what can TAC do cost-wise? What can Blue Cross, if they're going to be the carrier, what are they going to do cost-wise? What are we going to keep? What are we going to chunk? Those are decisions we need to make. If we're going to keep on with firm foundations, hallelujah. If we do, maybe people won't be driving to Houston to get a doctor's appointment, and we'll be missing more people at work, and the cost will go up. That's just on the self-insured versus the fully insured. I look at that. I'm not advocating for firm foundations. I'm just saying that is another aspect to consider. It's convenience to some people. And if you go see a PA that is, there, or a nurse practitioner or whatever, and they do have oversight by an MD, regardless, at least people are getting to see somebody. And maybe they can control whatever the ailment might be. If you toss them, then they're going to go somewhere else. And you're going to have people taking off all day to go to Houston or some other place that may be a specialist they have to be seen, and it might be more than one day. I'm not playing favorites here.
But I mean, you could still go there.
Yeah, you can. You can still do that too. Yeah. It's just going to be what is convenient, what makes sense for a county our size, the number of employees we have. What is the best product that we can deliver to these people to make a decision? and give them the best for their buck. That's all I want to do. So I'm still sitting here looking, what's the bottom line? And we're going to have to get to that bottom line either through TAC or through the Blue Cross side, whomever. And I don't think we're there yet. I think we're gonna have a lot of questions. So what I would suggest is y'all get your questions together and look at now. If we're gonna start this new insurance period, January the 1st, right? That's when it starts. It doesn't start September the 30th or October the 1st. It's January the 1st. It runs through December 31st. But we still have to make a decision to plug this into the budget. So it's going to be 8.7 million, right? Or is it going to be the 7.705 plus the other incidentals that go along with it? Let's look at that and make a decision based on what's best to where we don't see the pitfalls that Bruce was talking about. With the what ifs, we have refrigerated trucks outside with bodies in them, in case of another pandemic. Lord knows I don't want to see that ever again. But dadgummit, we got COVID, and now we got monkeypox. Before the next election, there's bound to be something else that rolls up, It might be buzzard flu. I have no idea. But yeah, what I would like to see happen is everybody get your questions together, that now that we have a pretty good description of what we're aiming for, let's get these questions together, either submit them to the committee, or we can come back after submittal to the committee, or come back here as a whole and just have a sit down. But time's running short, y'all. Hate to say that. Time's getting real, real tight. And I would like to pass the budget first go round in September, which would be the 13th, I believe.
It said you have to have a minimum of 30 days before January for them to even get the cards out and everything. in a
Yeah.
Timely manner. So you're looking at, November is when you have to.
Well, we'll have to make a decision.
Well, we still have to
for
make,
budgeting.
budget-wise, we still have
Yeah,
to
for
make a decision
budgeting purposes.
in September.
You could put 5 million in, you could delay the decision, but you can't delay it that long. You have to
Right.
let them know in November. So.
So y'all kind of see my point. I just want to make the best decision, make a money-saving difference for the county, and give everybody the best possible product we can get. And if tax the way to go, then jump all over it. If it's not, then just ride it out. But, there's a
I
lot.
think our insurance committee ought to get together and bring us a budgetable figure that we can go instead of having to add to it every year. Because we have these, they're not unknowns. We know the cost is there. We're just going to have to start showing where this cost is going. Or at least show it to Commissioner's Court that, this year we're budgeting this amount for this, and we're not sitting here going several $1 million over every year. That
Mhm.
doesn't work.
Well, the bad taste in my mouth is, you have a set price in the budget, and also we got to dump another $2 million in.
Yeah.
And where are we going to pull that rabbit out of your hat?
Yeah.
Especially in the economic climate we're sitting in right now. And, you have a fund balance, yeah, but eventually it's going to look like it did when I got here in 2015.
Just
doing that.
thank God we have a creative
Yeah.
auditor.
Oh, we do. I mean, we got, yeah.
Or we would be in trouble.
So,
One last thing I just wanted to just throw out there, and I think this does definitely warrant an additional conversation, is this is from Blue Cross's renewal. And I mentioned that there's two different types of stop loss. There's the individual stop loss, and then there's the aggregate stop loss. The aggregate stop loss, essentially Blue Cross says, this is what we're projecting your claims. This does not include your fixed costs, but based on your enrollment and how their workup, they're saying they expect your claims to come in just over $6 million. If they are off by more than 125%, they set an attachment point. That's essentially your maximum liability. So if you run, let's say we don't have any change in enrollment and the plan just runs way worse than is expected, we've got a maximum cost of almost 7.6 million, where that aggregate stop loss would kick in. and then the plan would not be, Liberty County would essentially max out their liability at that point. If I come back to our projected cost, so I just kind of put this together here so that I could give you the numbers. We're looking at a fixed, the fixed costs are just under $200 per employee per month. When I multiply that times 460 enrolled times 12 months, it's just shy of 1.1 million. If I take the attachment point plus the 1.086 million, your maximum liability at this enrollment without changing enrollment would be $8,670,000. Now, to Angela's point, that does not factor in the cost for plan source. It doesn't factor in the cost for firm foundations. It doesn't factor in some of those costs that are actually outside of the medical and RX plan. But if we were to not make any changes to the plan designs, it stays running the way it is. Your maximum liability, it stays consistent, would be that almost 8.7 million. Now, we don't expect it to be there. We're expecting that your total fixed costs, I had it up here. I'm shifting around a lot. Including your fixed costs to be at that 8.4 million. Almost 8.5. Because that includes your fixed costs. So I do think if we wanted to change the way that we set the budget and we fund the budget or set the budget based on your maximum liability under the self-funded plan, but then also make sure that if the budget is supposed to include firm foundations and it's supposed to include plan source, that we factor in those costs. But I think that would also be something you would need to factor in if you are thinking about keeping those and moving to TAG. And then the last piece of information that's, I think, important to keep in mind is Blue Cross's proposal from a stop-loss perspective is firm for 45 days after it's released. It was released on July 26th. We got approval from them to hold it firm through next Tuesday. I would have to go back and ask them to keep it firm for longer than that. But essentially, they have more information now that they didn't have when they released the proposal. And looking at July's claims, we did have a significantly higher July than we did in the previous 5 months. And it is very possible that Blue Cross would re-rate or could come back and say that they're not wanting to hold that stop-loss proposal where it is right now. I think we can get them to confirm, but we can't drag it out forever. At some point, they're going to want to take a look at and consider those new claims when taking a look at it. So right now, we've got a firm proposal from them.
Well, I'd like for us to get our questions together. I mean, today's Tuesday, I think maybe we could all have our questions together by Friday, since it's fresh on everybody's mind and the time limit is looming. And I mean, gosh, guys, we're not going to Las Vegas, okay? This isn't anything we're going to be betting on. It's a common sense issue, I would think, at this point. What's going to save money? What's the best coverage? And both of them look really good. Harold, you've been here for 37 years. I mean, what looks good? You've seen the ups and downs over the years.
Yeah.
Yep.
But you've never been fully insured, right?
Oh, no. Sure.
Not through that. Someone else.
No, we were, basically we had good years. We were a lot smaller.
Yeah.
We were paying in a lot of money and our claims were low.
Yeah. That's
when we self-insured. And there was points where we moved $1 million over it.
Mhm.
I say the last 15 years. That's not
Yeah.
And as we grow, I don't look for us to get a bunch of breaks. We're going to be adding new employees, hopefully a younger crowd. Us old folks kind of cost county money.
You got to start hiring younger people.
But we have got our pay scale up that we are attracting younger folks.
Yeah, we
They're
are.
not going to the plants and stuff. They're staying around here. And this is what I like. So I want an insurance plan that fits and helps us grow.
Well, as old Uncle Joe, the contractor would say, let me caution you, if you do change, be prepared to give the education that goes with it.
Nobody likes changes.
Nobody likes change. You're going to, oh, girl, you're going to see.
This wouldn't be my first new enrollment.
Okay.
Not at all.
Even when we had subtle changes, you know, in our plan in the past, it was, you know, it might have been just with the retirees. That was rough. I mean, I'd rather go to the dentist and get like 3 root canals in one day than have to go through that again.
The same way if we say partially self-insured, next year, Cigna and United Healthcare usually send them that quote.
Yeah.
What if they just blow Blue Cross out? You got the same problem, change another insurance company.
Yep.
With different networks.
Yeah. And I think the reason we're getting more favorable considerations from Blue Cross is we've been a customer for quite a while now, and they have some comparisons to look at. Even though we did have maybe a higher June or July. Yeah. Well, a lot of people had bad health issues in June or July. I mean, it didn't rain, so we had a lot of dust from the Sahara, whatever. Okay. All right.
Chuck, you're sharing your screen on the dental, so there's a higher rate for the fully insured for the dental as well. Is that correct?
Yes, that is correct. The fully insured quote rates are shown on the right-hand side. The projected fully insured equivalent rates, and now the dental's been self-funded. We've been using Blue Cross's network, and it's been pretty consistent year over year. The cost for the dental plan, each year we project a slight, right at renewal or slight decrease from where we are. The fixed costs are not changing, and based on how the plan's running, we would expect it to stay or have about a $20,000 decrease. But from a fully insured perspective, compared to the current budget rates, we're looking at $124,000, $125,000 increase. And then similarly, the vision, or smaller numbers, but that is a fully insured benefit. And then when we compare the current rates that we have with Blue Cross, it's about 18% higher, or about $8,300 more comparatively on a fixed cost basis.
Chuck, has Gallagher done any kind of analysis on how noisy the disruption would be from the prescription perspective?
From the medical prescription perspective?
From the change to Navitus network on the prescriptions.
I do not have the pharmacy disruption analysis, but anytime you change formularies, so even if you're staying with the same PBM, but you're changing formularies and how those prescriptions are dispensed, that is where you have the most noise, because that is the benefit that individuals use. You may have people not using the medical side of things, but the majority of folks are having some prescriptions filled through the plan. A lot of times the noise is, around the diabetic medications that are covered under the Prime versus what's covered under the Navitus plan. But I don't have the disruption. Time-wise, we could definitely try to request that and have an analysis done, but that would take some time. And I know we also are under,
time constraint.
I don't know how long that would take. Yeah, time constraints as far as getting that done. But if you were to change from Blue Cross to United Healthcare, their pharmacy benefit manager, there's always noise when you change the pharmacy benefit, because of the formularies are never the same. And what is covered as a tier 1 might be covered as a tier 2, and there might be some drugs that are covered under one formulary that are not covered under the other. If we were on Navitus now and we were to move to Prime, you would have noise going that direction as well. That's usually where you see most of the noise when making plan design changes, because that's the one that more people use that benefit than they do the medical benefit.
Okay.
And I can send this slide over here. I mean, this, I just kind of, we went through side by side. Blue Cross actually came back and gave some rate relief on some of the ancillary lines as well. So there's, you know, TAC quoted on all of the lines, basic life, voluntary life, the voluntary STD as well. Blue Cross came back actually reducing some of the rates on some of those benefits. We already went through all of the marketing with the benefits committee, and based on what we got back from United Healthcare and the others, I think if you're looking at staying self-funded, Blue Cross was the logical option. But then now we're looking at, so this is just showing the comparison between Blue Cross and tax proposal.
All right.
I have no more questions.
You got anything else? Anybody? Eddie? Good? All right. Ready?
I'm good.
Angela? Catherine? Leon, you still with us? Yeah. All right, well, y'all get your questions together, whatever they are. Let's hammer this out because we're running short. Okay. And I guess we'll call this one saucered and blowed. What do y'all think?
I think so, Judge, and I think Nick is in charge of moving us over to the insurance committee meeting. I don't anticipate that will take very long.
All right. Good deal. We'll close this one out and we'll get started on the other.